Good afternoon from DBS Asia Central. We are here at Level 3 Spark Studio. Welcome you to our March Macro Insights Livestream, largely about Iran and macro implications and market forecasts around that. We are privileged to have with us our three top strategists, Eugene Leow, Philip Wee, Chang Wei Liang. Gentlemen, welcome to the live stream. It's been quite the week.
It is incredibly volatile.
Very volatile indeed, and God knows when the volatility ends. I think expectation of a very quick resolution is going to be falling short. So what we will do, as we always do, is start with the macro part of the presentation. Then Eugene will take over, go over the rate side of the story. Philip will follow with the FX side of the story. William will come in, credit, crypto, and perhaps some of the other FX overlays which may or may not be covered by Philip, all of that. We will also have Q&A. So let's just get going with the presentation slides. So Middle East conflict and implications for Asia. And as I said earlier, that I will go with the macro, Eugene, Philip, and Wei Liang would follow, and you would have time to ask us questions. How do you ask us questions? Several ways. You can scan the QR code on the screen right now, or you can go to dbs.pigeonhole.at, type the password macromarch26, and that'll take you to the portal for sending us questions. I'll keep an eye on them as the call progresses and bring them up to the screen during the Q&A session. Don't worry if you have not managed to capture it right now. We will bring this back to you between every single section. So for my section, Global Economic Outlook, let's put the oil price situation in perspective. So many breathless headlines of $100 oil, and we ourselves have done quite a bit of analysis on if indeed oil is at 100 for the whole year, what would that mean for regional growth, inflation, current account balance, and so on. But that $100 oil, while it may be problematic for forecasts, problematic for economies, from a bigger picture perspective, it is not that big a shock. Look at the real price of oil over the last 25, 26 years. Starting way back in 2000, setting it to 100, what has oil done adjusted for inflation during that period? Well, the peak was actually right before the global financial crisis. In 2007, global demand was red hot. Then the crisis came and the global demand was not hot at all, and it collapsed. But then it came back up pretty fast. I mean, those of you who were in the markets or followed commodity in those days will remember very soon, by 2010, oil was well above 100 for quite a bit of time. Then it came down substantially and had a bit of a slump in the pandemic times. Then it came back again. But again, when you adjust for inflation, we are nowhere close to where oil prices were way back in 2007. In fact, as you can see in the little caption I have next to the chart, at $90 a barrel, which is the prevailing price right now as we speak, it is about 57% below the peak of 2007. I'm not downplaying the impact of $100 oil. What I'm trying to say is that from a global growth perspective, from a global economic resiliency perspective, we are capable of taking this shock. It will be more costly, it will be problematic, it will not lead to a global depression, it will not lead to recessionary tendencies in most cases. You will see what I mean by most cases a little later. So what if oil stays at 100 per barrel for the whole year of all of 2026, which of course would mean it's going to in the 105, 110 range for the rest of the year, because we already have January and February significantly below 100 behind us. Now, our economists in the team, from Moji's team in Hong Kong to Radhika Rao, Chang Wei Liang, Ma Tieng, they have done this comprehensive analysis, and I've sort of summarized those numbers on the screen. As you can see, there are some countries more vulnerable than other in terms of sensitivity to oil is concerned. And if you think about a country like Japan, where the forecast was about for 0.5% growth this year, it might tip them into negative growth territory if indeed oil stays that high. Japan, of course, famously imports most of its energy, and a lot of that comes from the Middle East, from the countries that are right now being afflicted by drone and missile attacks by Iran. Thailand is another country that pops up to us, has about a 1.4% downside to the economic outlook if oil does stay up at around 100 for the rest of the year. Korea will also see halving of its growth. Instead of 2% plus, it'll be 1-ish. But then there are other economies where it doesn't seem that bad. China, for example, we only look at about 0.5% downside to China's growth trajectory in 2026, largely because China has the capacity between its strategic petroleum reserves, between its substantial refining capacity to take care of its own for much more prolonged period than most countries in Asia do. India doesn't have a very large strategic reserve, but it is capable of diversifying its oil, just like China, primarily from Russia, if indeed Iran and other places are no-go. And at the same time, overall growth momentum in India is substantial, that some degree of price shock can be taken in its strides by most sectors in the economy. Indonesia should actually be growing faster, not slower, because of its net energy position, but nonetheless, high oil prices do transmit to the local economy. It does create conundrums from the authorities in terms of subsidy policy, fuel pricing policy, upstream, downstream companies' margins, and we do expect that, again, to be responsible for shaving off some growth. Taiwan, the high-flying economies in Asia, also has about 100 basis points downside from this. What about our own little red dot, Singapore? We are looking at about 40 basis points of downsides to Singapore's growth outlook. Singapore has substantial dependency on the countries that ship their products through the Straits of Hormuz, but at the same time, whether it is the natural gas pipeline from Malaysia or alternative sources of LNG from Australia and the US or parts of Africa and crude oil from alternative sources, Singapore has a fairly diversified energy base. So yes, it is 100% reliant on imported energy. Yes, it doesn't have a green footprint that the likes of China does, but at the same time, it has a wherewithal to deal with shocks like these, and which is why we're not keen to downgrade Singapore's growth forecast in a very rapid manner. What about the inflation picture? Well, it is unambiguously negative. Everywhere, depending on how much energy prices will be passed through, we've made certain assumptions based on historical episodes when oil prices spiked and what the authorities did with respect to inflation and price of energy products at the pump level. Based on all that, our view is that most countries in Asia would have about 50 basis points of upside to their inflation outlook, some much more than that. Look at Korea. We talked about halving of the growth forecast, but we're also talking about doubling of the inflation forecast. Now you know why the Korean market has been selling off so much. The market understands this macro vulnerability and pricing in substantial negativity as far as the Korean markets, Korean economy's outlook is concerned and its implication for markets. But it's not just Korea. We look at Taiwan, we look at Japan, substantial upside to inflation from energy price pass-through. Then you have something like Thailand, which has even more dire inflation implications than the countries that I just mentioned. So from a rather benign inflation perspective, we looked at inflation momentum in Asia. In fact, made a publication out of it around that theme in January, saying how favorable inflation momentum is just about everywhere else in Asia. The big question was, when does inflation bottom out? Well, that question has been put to rest. Inflation has bottomed out. It will jump substantially, depending on the duration of the crisis, depending on how deep the Straits of Hormuz related shipping shutdown is. But some of the damage is already done, and prices have jumped. Expectations have adjusted accordingly, and cost of dealing with the energy market will be higher for quite a few months, if not for the entirety of 2026. Now, when we talk about energy, we miss out on sort of the non-energy angle of this issue. It's not just that we are trading energy with the Middle East. We sell quite a bit of things to the Middle East as well. Look at India. When you look at this chart, far left corner is India, because that is the country that seems to be most vulnerable or most dependent to an oil shock or problems in the Middle East. India imports about close to 20% of its total imports from that part of the world. And by the way, just to be clear, there's a footnote there. What is the Middle East in this particular context? It's the countries that have poor presence and water access around the Straits of Hormuz. That would be Iran, Iraq, Kuwait, Qatar, Saudi Arabia, and the United Arab Emirates. All right, India imports about 20% of its total imports from that part of the world, and of course, it's largely energy. But it also exports about 12.5% of its total exports to that part of the world. That is not energy. Maybe a little bit of refined fuel here and there, but largely it's consumer goods, it's agriculture products, processed food, gems and jewelry, electronic products, even capital goods. If you see construction projects in your travels through Qatar and Abu Dhabi and Dubai, you will see lots of tractors and cranes. They're not from John Deere US. They're from Mahindra & Mahindra, L&T in India. So those sort of exports will, of course, face problems if indeed we see this sort of shipping disruption continue. So India's vulnerability is very well recognized. On the export side, for the rest of Asia, it actually doesn't look that bad. Asian countries are very global as far as their export orientation is concerned. Outside of India, they're trading with the US, Europe, Latin America, Africa, and of course Middle East. But by and large, as you can see from this chart, not a single country in this chart other than India has more than 5% of their exports going to the Middle East. So if 95% of your exports are proceeding without any problem, and even that 5%, some of that can probably go through the Red Sea and be cleared through the ports in Saudi Arabia and make their way to these Middle Eastern countries through land route, well, I think that can be managed. Will cost more, but I don't think the Qataris and the Emiratis are about to run out of their supply of Apple phones or Korean TVs or EVs coming from China. I think they will come, even if these ports get closed. Saudi Arabia will help them out. So I'm not particularly worried about the export side of the story, with the exception of India. On the import side, it's substantial. Look at Korea. More than 10% of its total imports, and of course, by imports we mean energy, is coming from that part of the world. Thailand, even Singapore, substantial import linkage. So the vulnerabilities are substantial on the trade perspective, but import side, much more of a concern than the export side of the story, India being a big notable exception. Let me move on from these vulnerabilities. I'm just going to cap off my presentation with a little flavor of what's going on with the fixed income market and the FX market, although, of course, Eugene and Philip will talk about these things in far more granular detail. You can see in this chart, although I have three yield curves, the US yield curve as of end 2024, as of end 2025, and as of the 10th of March 2026, you can't really see the difference between the current yield curve and the N25 yield curve. So market hasn't really managed to change its view on the directionality of Fed funds rate, on the US fiscal positioning, bond issuance, all of those things. This crisis is seismic. People are sort of very worried about the outlook, but it hasn't really translated into significant repricing of bond products. And again, Eugene will talk about these things in greater detail, but my main point is that the upward sloping yield curve that we have, as opposed to an inverted yield curve or a very flat yield curve, still suggests that market's view on substantial US issuance, market's view on fading Fed independence, or market's view on whoever under Warsh runs the Fed will be cutting rates by a little more. All of that is still very much intact. There hasn't been any wholesale repricing of any of those expectations due to the events in the Middle East. On the FX side, the big story is that there's a risk aversion trade going on, and there's a dollar smile out of that, and there's an appreciation story going on. But look at the story from a 3-4 year perspective. The dollar is still very much on a bear cycle. It's been weakening substantially since last year, and whatever we see right now in terms of some risk haven flows, I really don't think that changes the structural trend. I actually haven't run this observation by Philip. I hope he and I are on the same page on this. Okay, so that's all at my end. I'm going to hand the baton to Eugene now to talk about global rates markets. Eugene, time to talk about some rates.
All right, thank you very much, Timer. So Timer has brought us through the entire very, very big picture kind of view on this Iran conflict. And I'll just drill a little bit deeper from a rates fixed income perspective. Yeah, so the next few slides, I'll just take you through different ways of viewing this conflict, right? So the first one is in terms of financial conditions, and that's the gray line. And how would you define financial conditions? So the first one would be how bullish or bearish the market is. If the gray line is very high, it means that people are very optimistic, right? Things are going well, stock market's going up, and then credit spreads are tight, right? So no funding issues, etc. And I also put like the Fed hike, Fed cut cycle. So what you will notice is we are nowhere near the periods of extreme stresses. So what do I mean by that? Right? 2022, 2023 was one period of extreme stress. So at that point, we have the Fed hiking very aggressively, inflation also very high at that time. And yeah, the financial conditions were pretty bad. And then more recently, people will remember last year, Liberation Day, right? The terrorists were a huge shock. And yes, we get a dip It was a short one, but it was a pretty meaningful risk-off for a little while. But since then, things have been going pretty well, right? So tariffs are not as bad as it should be, and then yeah, stock market's still grinding higher. A lot of optimism on tech. Yeah, so we haven't had a proper risk-off in quite a while. The last 2 weeks shook this assumptions a little bit, right? So we have higher prices. Does it mean that stagflation has come in to be a key worry? Will global growth momentum stall, right, if energy prices get too high, right? So we can trace the source of stress, right? The source of volatility, in fact, it is just largely into commodities, energy, oil and gas. This leads to one of the themes that we talked about early this year. So we lay out 4 themes. One of that is inflation, complacency. We should be watching commodities. Right, so we just split out the prices, index them, and then split them into 4 different areas. So we have precious metals, which is really just gold. And then the second part, which is base metals, and then we have energy as well as food stuff, right? So what came out first was really precious metals, right? This accelerated over the past year because of Liberation Day. People are worried about debasement. They want to diversify out of the dollars. Yeah, so this really took precious metals to very elevated levels, right? And then shortly after, we have base metals following. But that's a different kind of narrative. It's really AI and then the related supply chain, right? This is going to be a structurally bullish kind of demand for these kind of metals. And that also gets dragged up. So the thought that the early part of the year was really okay if it's just metals. Maybe there wouldn't be too much of an impact on the overall inflation picture. But we should keep an eye, right? Oil prices, people have been talking about oversupply for a very, very long time, right? So there's always this sense of complacency and overly bearish kind of view on energy, right? So it's vulnerable to some kind of a shock, right? So, and this shock materialized when the conflict in the Middle East kicked off about 2 weeks ago. So there was a spike, and now we have energy also joining the fray. The only thing from a commodities perspective that is still roughly behaving is food, right? Food-related inflation is still contained. But if that too starts to move, we probably need to figure out how much of an inflation impact there would be onto many, many parts of the world. So again, drilling a little bit deeper, right? How hard hit would we be, all right? So to a period of higher for longer energy prices. So Europe is vulnerable. We saw that in the Ukraine-Russia conflict, right? Very vulnerable to a very sharp increase in gas prices. They have tried to diversify their sources, but by and large, if you're importing large amounts of energy, you will still be somewhat susceptible to these kind of energy price spikes. Asia as well, we are net importers. Many of us are net importers. So if this gets prolonged, again, it's not that constructive, right, for our, say, current account or balance of payments flows. And for developing economies, food, energy has a larger weightage. So the pass-through on inflation is also significant, right? So in terms of the ability to contain prices, right, it depends on the mechanism as well as whether the governments have the fiscal position, the leeway to try and cushion this kind of a blow, right? So in terms of the DM space, we are seeing some of this in the market, right? We are seeing break-even starting to rise. And the vulnerabilities, again, is echo what I said earlier. It is UK, it is Europe, and the US, the long-term inflation expectations is still somewhat contained. So what about broader markets as a whole, right? It's very difficult to look at rates in isolation. So the tables on the left, I think we need to look at the interplay between rates and FX. And I would note that the figures shown there and figure roughly where we are today, it's really more of a midpoint between the extremes, right? So it does not capture the volatile swings that we saw right at the height of the panic on Monday, when oil pushed decisively above 100 and reached like 120 for a while. At that point, the interplay between stresses on the FX side, especially in Asia, was very, very acute. And when these stresses appear, it spills over onto short-term and long-term bond yields in the region as well. So I think this interplay, aside from being a sentiment-related push, we should also know that from a fundamentals perspective, higher for longer energy prices in general is not that constructive for Asia. Right? But for G10, it is a bit more nuanced. The vulnerabilities are still there. But what I will highlight is another point, another theme that we brought out at the start of the year, and that is on the fact that central banks are pivoting. Right? Last year, it was decidedly a one-way street. Right? If inflation is benign, it allows central banks to normalize policy. Right? So interest rates have been cut, and in many cases, they are at neutral. In some cases, perhaps below neutral. So if you look at the pricing, right, this is playing out, and this is exacerbated by this conflict in the Middle East. If you have to think about higher inflation, right, if you have to think about how to counter that, it has to be holding rates steady or pricing in some hikes, which is the case across the G10. Right? Only the US stands out as pricing in just over one cut over the coming year or so. So this theme is also playing out as we speak. Now, when we think about interest rates, right, the macro considerations are incredibly important. So we can roughly place them into 4 different quadrants, right? You can be in stagflation, right, which is weak growth, high inflation. You can be in Goldilocks, which is low inflation, great growth, or you can be in overheating or recession. Right? Over the last 5-6 years or so, we have run through all of them. Right, from the pandemic, where it was clearly a recession, it was slow growth, negative growth. It was also very low inflation because there's not much activity that can be done. So we swung to the other end, right, in 21, 22, where things are reopening. Right, when reopening, there's a lot of momentum, and then you collide together with maximum stimulus at that point, and then you add in the high energy prices that came from the Ukraine-Russia war shock. Right, so you add in, you swing from recession into overheating. And the hikes, the tightening from the different central banks have helped. So we push inflation down and we go towards the Goldilocks area. Right? So we have strong growth, low inflation, which is generally great for risk-taking. And then more recently, even as inflation stays low, the labor market in the US has been weakening slightly, so no longer overly tight. So we are gravitating towards the middle of the chart. Right? So the question then becomes, how should policymakers adjust? How should we also think about the plausibility of either stagflation, overheating, recession, or will we actually stay back where we are, which is Goldilocks? Right? So I think that the issue is that the war brings about the specter of stagflation, and there's a little bit of overheating risk. Right? So those are just levels, right? So if you think about levels of dollar rates, it doesn't look like they have moved very far from where they are now compared to the start of the year. Not so much. A lot of volatility, but we are still in that range. Think about the curve. It is also still the same kind of narrative, right? So if you look at the curve, 2/10, red line, and then the gray line, which is the Fed policy, if the Fed tightens and keep rates high, you will have flat curves. If the Fed decides to cut rates, the curve will steepen. So the Fed has been on some easing trajectory for the past 2 years or so, and the curve has steepened. So that is what is likely to happen. We still think there is some room for Fed easing in the second half of the year, but there's a little bit of a rethink in terms of how steep the curve should be. Right? If there's stagflation, then perhaps the curve should be a little bit flatter. Is there a little bit of risk aversion that we should also be aware of? Then that is keeping the long end treasuries a bit more bid, right? So I think it's a mixture of a few things, but insofar as financial conditions are okay and sentiment is okay, then there should be room for curve to steepen a little bit more once this blows over. Right, so I think in the end, we should figure out the different paths and themes that we should be considering. Right, so the 4 themes that we brought out at the start of the year: K-shaped economy, Fed independence, inflation, and then the central banks reaction. All these are important. It's just that there has to be some kind of an overlay, right? Because the conflict in the Middle East is now top of mind, and it impacts the different parts, especially the last 2 points, right? So the range of scenarios that could play out from there is important. I think that in terms of risks, in terms of the real economy, I think things are okay. We can probably handle oil prices in the 80 to 100 range, as Timer mentioned, right? In real terms, oil is not that high. But if oil gets too high, right, above 120, above 150 for an extended period, then we'll have to think about constraints on consumption. We have to think about would there be some recession risk, right? So, yeah, we should just keep an open mind and know that the range of probabilities are pretty wide at this point. So, yeah, so before we invite Philip to explain a bit more on FX, if there are any more questions, feel free to scan the QR code. We'll be happy to address them later. Yeah, Philip, over to you.
Yeah, thanks, Eugene. Okay. Okay, I'm going to cover the FX. Looks like we have kept the time pretty well. Okay, first and foremost, I guess the most important thing is to show you how FX has reacted ever since US and Israel invaded Iran. So it's hard to sort of believe that it's only 1.5 weeks so far, and this is how the currencies have performed. Timer has already explained, I think in terms of sensitivity, Asia is more exposed. So you can see here, in particular, the Korean one has been the most volatile. Okay, so the way to read this chart is, this is the maximum fall since the end of last month. So you can see that when oil prices hit, say 120, before it pulled back to 90. So this is sort of the ranges that has, I think, played out in the market. I have this feeling that we probably will be looking at this kind of ranges. Still do not discount the fact that oil price can still go back up. But I think the long and short of it is that the harder you fall, the faster you recover too, together with oil. And the other thing is that, yes, we have seen dollar hit new highs against the Korean won, the IDR, the Indian rupee, but then back again, that it is only quite modest, So, and especially for, let's say, Indonesia and for India, the percentage move is actually much slower than the other currencies like baht and peso. Okay, I want to sort of bring us back to the Ukraine war. So it's exactly about 4 years ago, so when Russia invaded Ukraine, and Brent was about $99, so so today, Iran, the launch point was around 72.50. But what is quite interesting to me is that the past 1 to 2 weeks, the spike in the oil, in both cases, I'm hoping to see this time a repeat also of the spike, within 1 to 2 weeks, the intraday spike. So, and bearing in mind that yes, we discussed a lot about this being a long-term war, but then again, the war in Ukraine is still continuing into its 4th year, but markets have adjusted. But this time, the big challenge is really the Straits of Hormuz, where it is a maritime choke point for the global oil supply. So that is the part that needs to be eased, So, and hopefully, with Trump coming to some kind of pronunciation, taking him at face value, that maybe this whole thing can really end within the next 4 weeks. But let's see. Okay, but the interesting thing is that in 2022, the easing came markets got relief when US released the Strategic Petroleum Reserve. So we have the G7, IEA also talking about releasing the emergency stockpiles right now. So I think market is sort of taking some comfort in that. Okay, I think the big question now is that will this translate into Fed hikes like what we saw in 2022, bearing in mind that that was actually the reason the dollar surged. Fed delivered 475 basis point hikes at 4 meetings. So, but today, DXY is still pretty stable within its 10-month range. So between 96 and 101. So and the market is not looking for hikes. Market is still pricing for 2 rate cuts, which is basically where we are at also. Okay, so looking back, so the dollar question really rests also with the Fed outlook. So very quickly, to avoid duplication, just want to say that yes, we do look at oil prices, but I'd like to pay more attention to the year-on-year changes, and also bearing in mind that oil prices, have, before the war, have actually been still rather weakish, trending down. Whereas, let's say into 2022, oil prices have actually bottomed from a much lower level of $20 per barrel. So to the sort of the around the same launch point as like the Ukraine and the and the Iran war. Okay, so but the other big difference is that if you look at the Fed's dual mandate back in 2022, the catch up in terms of the rate hikes, all you have to do is just look at the Fed funds rate. So it was above. Fed had to bring it above inflation rate, above the unemployment rate. Today, the Fed funds rate is below the unemployment rate and the core PCE deflator. So which in many ways, why you see a muted reaction in the G7 currencies. In fact, just today, I would say that Australian dollar, which is the biggest monetary policy divergence play, it hit a New Year's high again. So it was hit pretty hard, when the oil prices spiked, but then it came back, even harder, primarily because now the market is betting on the RBA delivering a back-to-back rate hike, because it's definitely more concerned about inflation than about growth, So, okay. And earlier in the week, I wrote in our weekly that I was quite intrigued that despite the higher oil prices, the dollars didn't really perform as well as a haven. So upon investigation, so I've sort of filtered out all these 3 factors. I think the first clearest factor is the monetary policy divergence. Markets still believe Fed will deliver 2, sometimes 3 rate cuts this year. It removed the 2 rate cuts from the BOE, and it actually priced in 2 hikes by the ECB, and it brought forward one of the 2 hikes that they were looking for RBA into its next meeting. And Fed, within the Fed, the Trump appointed Fed governors like Myron, Bowman, and Waller, they were all pushing for 75 to 100 basis points. And of course, non-farm payrolls disappointed. It came in negative when consensus was looking at a positive, a sort of neutral number. Then on the fiscal side, the concerns returned about sustainability. Pentagon reported that the first week of Operation Epic Fury cost about $6 billion. So everyone, went and did their books and realized that this is going to add to the bill on top of the tariff refund from the Supreme Court's ruling against the IEEPA tariff. And the Custom Border Protection Agency has already come out to say that they should get the tariff refund system ready by next month. And the CBO came out with estimation of $2 trillion additional, I think, debt over the next 10 years. And within, let's say, Congress and the Trump administration, we all know that there's a spectacular clash that led to the firing of Kristi Noem as Homeland Security. And Attorney General Bondi is facing impeachment risk, and Pete Hegseth is also facing bipartisan pressure with regards to Iran. Okay, so coming to the Sing dollar, so far I don't detect any big fear in terms of the market reaction. The correlation between the dollar Sing and the DXY index is still pretty much intact. So we have not changed any forecast, and we believe that we should continue to monitor the situation. But while acknowledging the volatility, that is being wrought by the volatile oil prices. Okay, but the government is nonetheless looking to review the GDP forecast and the core inflation forecast that they have recently revised up due to the to the high oil prices, which they expect is going to pressure businesses and consumers. So Singapore, 45% of our LNG comes from Qatar. Okay, so but for sure, MES is going to keep the Sing near, appreciating. And the question now is, do we need the slope to be steeper? But that's all depends very much on whether the outlook is leaning towards, let's say, some kind of 70s oil shocks where you have a global recession. But I don't think anyone is moving into that direction yet. So it's pretty much similar like what we had with the tariff shock, last year. We've never seen something like this, but 6 months later, the whole world was sort of pulled back their pessimism and saying that tariffs didn't turn out to be as bad as what everyone thought. Okay, so all in all, it's still watch. Let's just watch the situation, and and we'll see what most governments, including Singapore, will adjust in terms of their the balance between how they view oil prices as a growth risk or a bigger inflation risk. Okay, okay, I'm going to finish off with this last slide. I always find Trump's trip to China quite intriguing because it fits in with the 4-week, deadline or his timeline about calling some kind of end to the Iran war. So quite clearly, Republicans are quite concerned about the midterms. So they're very keen to shift the narrative. And the summit is one potential place to shift the focus towards China, containing China, then rather than defending, the war in Iran. President Trump is also, would probably like to change his image to one of a power broker. So this is where there are lots of talks about China buying Boeing 747 and US soybeans. Okay, so at the end of the day, the visit could be one that provides a political off-ramp from the war by positioning, that the China visit will be a victory for U.S. workers, shifting attention away, the concern that the Iran war is going to be a risk for American soldiers. So I'm going to leave it, I think, here. But generally, just pay attention to the summit as a potential off-ramp for this war. Okay. So I'm going to again remind everyone, please scan the QR code. I'm sure you have lots of questions, so be very happy to answer them later at the Q&A. And now I'll pass the baton over to Wei Liang.
Right, thank you, Philip. Right, so I'll be briefly going through what has happened in credit markets, and I'll touch on a little bit about the safe havens that has come up in this conflict. So just a quick reminder, if you like to drop your questions, here's the QR code on the screen. Scan the QR code, and then we'll answer them later on. So on the next slide, what has happened in the equity market space and credit market space, I think is fairly interesting since the outbreak of the conflict. We've seen very huge amount of volatile moves in Asian equities, right? So if, for instance, Korean equities, it has the worst two-day drop ever since the 2008 financial crisis, where you have the Kospi falling by over 18%, and the very next day it rebounded 10%. So this amount of volatility, I think, is quite unusual. But have we seen anything close to that in credit markets, especially in Asia? The answer is no. I think that speaks to two things. First is that the equity market space has a lot more retail investor participation compared to credit markets. And it seems that right now, the institutional investor, they're not really looking very significantly at the risk of a prolonged conflict. So for instance, if you take a look at the oil futures markets, you can see oil prices that are further out in the futures, they're actually lower than spot prices now. So there's backwardation in the commodity futures curve. So the expectation is not very significant risk of prolonged disruption, and that's exactly what we're seeing in the credit market. So this chart over here shows the investment grade credit spreads for US credit markets, European credit markets, and Asian ex-Japan credit markets. By and large, you see spreads have widened a little bit. Yes, there are some wobbles, but they are nowhere close to the huge spikes that we've seen back in April 2025 when Trump first announced his Liberation Day tariffs. So by and large, credit markets not as volatile as what we see in the equity space, which is a good sign. It shows that professional investors, they're not really panicking right now. They're assessing how the situation is going to evolve. Also at the same time, I'll just mention Asian credit has done far better than US and European credit, and that's really for idiosyncratic reasons. I'll briefly touch on that. Real estate, especially for China and Hong Kong markets, that's seeing some kind of a sentiment stabilization. But does that mean that we're out of the woods? Not quite. There's still a lot of growth risks, as Timo mentioned earlier. Major Asian economies, China, India, Korea, Taiwan, they are all very large energy importers. If the risk of prolonged energy disruptions are to materialize, then that's going to have some implications on inflation. That's going to have implications on growth. So probably at this point in time, when spreads are quite tight, not too different from what we've seen at the lows earlier this year, it's probably time to be a bit more cautious, especially if growth risks turn more prominent. The second point to note is that global investor appetite, actually credit investor appetite, has changed slightly. There's some talk of AI disrupting the software industry. So we all know about software eating the rest of the world. But now AI is eating software. So there's this talk about SaaS, or software as a service, companies getting a lot more risk to their earnings stream. We've seen news that private credit funds see more redemptions. Just this morning, we see news that JP Morgan is marking down the amount of valuation for credit funds, private credit funds. So there's definitely a little bit of worry about private credit, and whether or not that will spill over to public credit. I think that's a risk factor that we should be watching, especially given the geopolitical uncertainty in this space. So let's drill down a little bit into Asian ex-Japan credit. So I've mentioned earlier, by and large, Asian credit markets, not a lot of volatility, but you can see actually the distribution of returns across different sectors are quite varied based on a year-to-date basis. As I mentioned, real estate has seen the sentiment stabilizing, so actually spreads in that space have compressed quite a bit. But on the other hand, which are the sectors that are more vulnerable to energy disruptions? That's your energy sector. especially your downstream refiners. They're going to see pressures on their refining margins. Can they pass through higher crude oil prices to their end customers is question mark. There's also some sell-off happening in the utility space, and that's no surprise as well, given the risk of disruptions and higher feedstock costs. So you can see, actually, there's a lot of changes in the Asian credit market. It's just not too apparent on the surface level. So as I mentioned earlier, energy being one of the more vulnerable sector, we've seen spreads actually widening quite a fair bit more compared to the basic material sector, even though in the past, historically, they're very highly correlated. So expect more changes, more divergence in this part of the market, especially if oil prices are to hit higher again. So those of you who were dialed into our webinar last week will remember this chart where we explain how we think sensitivity of different currencies will be to oil prices. And actually, it's a good time to update this based on 2 weeks of intraday data. Right now, markets, they're very focused on oil prices. So it has become the dominant market driver and giving rise to very good data set for us to estimate. And you can see, actually, by and large, not too different from what we initially thought will be. So Aussie, RMB saying they are more resilient to oil price heading up. But on the other hand, other Asian currencies, INR, IDR, Ringgit, Thai baht, Peso, they are a lot more vulnerable. So if oil prices are to remain persistently high, then we could see greater divergence within the Asian space. For Korea, the won has weakened a lot, but it's not at all clear whether it's linked to oil. It seems to be more or less linked to the fact that the US dollar has rallied very sharply. So based on our estimates, surprisingly, the ringgit may be a little bit of a loser if oil prices remain high, even though Malaysia has a net oil exporter status. But by and large, it all depends on where our prices are going, right? So if the IEA does release its emergency stocks, we see oil prices coming down. By and large, Asian currencies should be more resilient, should be able to make a bit of recovery based on that. Last but not least, I'll discuss a little bit about Bitcoin. So Bitcoin, back in January in our Crypto Digest, we have this hypothesis. We think Bitcoin can be a geopolitical safe haven, right? So everyone knows it's a risky asset. But if you think about it, if you're a refugee in a wartime scenario, will you be taking your gold bars across borders with you through war zones? I think very unlikely. So Bitcoin has the advantage over gold in that you can actually carry it on a portable thumb drive. You can bring your wealth across borders if you need to escape war. So has that thesis played out well? Actually, by and large, not so clear. If you look at how Bitcoin prices have performed since the outbreak of conflict between the US and Iran, it's by far the largest or best performer. It has outperformed the Aussie, outperformed gold. It's up by 4%. But if you look at the sensitivity of Bitcoin to oil prices, and we're using oil as a proxy for geopolitical risks, actually it's nowhere close to where gold is. So for gold, very clear, it's a safe haven. When oil prices go up, higher geopolitical risks, gold tend to do well. Bitcoin, to some extent, yes, there's a positive effect, but not as much as gold. So the geopolitical safe haven property of Bitcoin is still very much to be established. Much of what we have seen in terms of Bitcoin performance has been mostly due to Trump's announcement that he's supporting a crypto lobby in his tussle against the banking lobby with regards to stablecoin remuneration. So there's a bit of positivity in Bitcoin space. And the safe haven property of Bitcoin, I think, is emerging, but it's nowhere as large as gold right at this point in time. So with that, I will bring in the rest of the team to go through the questions from the Q&A.
Thank you very much, William. Lots of questions, a dozen of them. Let's see how many we can get through, given that we have about 11 minutes in our time. FX, let's start with a currency question. Which currency do you feel can act as a hedge against US dollar over the long term?
Well, it's still my favorite currency, the Australian dollar. So yes, I was a bit concerned about the pro-cyclical hit to the currency. But as you can see, it rebounded very quickly because RBA is definitely prioritizing inflation more than the Fed. The other thing is that Australian dollar, if you look at it, it is the top performer. I think 7.7% against the dollar this year. And the other currencies are still a distant second. So I like to view it as the gold standard.
What about our good old Sing dollar?
Sing dollar is always stable, backed by fundamentals, but it will track the dollar index very closely. So, I think there's a question on the euro.
Let's go there.
Yeah, so
Here it is. What are your levels up to which your USD can go during this conflict?
well, before the conflict, I was hoping for euro to move into a higher 120, 124 range. So now we are back into the 115, I think 120 range. So in that regard, I also see dollar Sing still holding within that 125 to 130 for now. So but I am monitoring for this Iran thing to be, assuming that we find some kind of solution that is acceptable to the market, especially with the Straits oil flowing again, then focus can turn very quickly to the Fed. So where right now the Senate is not even holding its confirmation hearing, for Kevin Walsh. Yeah.
Right.
Yeah.
Okay, let's move to a rates-related question. Eugene, what do you suggest for interest rates investors to position? Not quite sure the question means. Maybe you get what the question is.
Yeah, so I think the issue here is to keep some of the big picture things in mind, right? So one of the things to focus on is inflation, right? War inherently is inflationary, whether it drives up commodity prices, whether it drives up more defense spending. And then this also comes at a time when there's a lot of AI-related infra build-out that's required over the coming years. So if these things are taking place, then we need yields to hit a certain level before you get comfortable going long bonds, right? So on a more simplistic terms, if you want to look at it very, very short term, look at those that are pricing in some hikes already, right? That might be a bit more interesting than those which are pricing in no hikes or even cuts, right? So that's one way to look at it. Another way to look at it would be the curve, right? The curve, we are still in the steepening camp, right? So yes, we are taking a bit of a counter trend right now because we have a little bit of risk aversion, we have a little bit of this stagflation kind of worries. But if this Iran conflict goes back into the back burner for a bit, then we could go back to the Fed being able to cut a couple of times. We'll go back to, hey, the economy is doing okay, hopefully, then the long end would go up again. So keep in mind, steepening is still our long-term view.
Very good. Eugene, thank you for that. I will actually first get rid of that question. Answered. All right. Quite a few questions on gold. Surprise, surprise. Can you share the bank's viewpoint on gold and silver? In current juncture, prices are falling. Gold used to be a safe haven in times of volatility. How come it's not now? That's question one. I'm going to put another question on the screen. If inflation goes up and rates have to be hiked, what do you see the gold price? What is the possibility of gold price dip over the next 12 months? So gold is a complicated story now because there are a couple of things that are not going in favor of gold. First of all, is the level of price itself. Worldwide, jewelry demand has collapsed because of extremely high price of gold. Worldwide, central banks, with the notable exception of China, are scaling back on gold purchase, again, for the same reason, that it is just very, very expensive to buy a ton of gold. And the fear is that at this high level, you're probably buying at the top of the market, and you might actually suffer some capital loss if you buy now. So there is this natural impact on the traditional buyers of gold that they're sort of recoiling at the exorbitant price of gold right now. Having said that, geopolitical uncertainty, weaponization of the dollar, untrustworthiness of the U.S. regulators with respect to financial sector exposure to the U.S. All of those things are creating a secular de-dollarization trend. And be very, very careful, and we've discussed this many times in past live streams, when we say de-dollarization, we're not saying the U.S. becomes some second-rate currency. No, it will remain the prime currency in the world. It will be the most widely held currency in the world. When we say de-dollarization, we're talking about inclination toward greater risk diversification. That alone is sufficient to propel up gold and alternative currencies like the Aussie dollar that Philip loves, and for that matter, euro and the yen and the Sing dollar and so on. So there are sort of countervailing forces at play. Safe haven should lead to some degree of buoyancy for gold, but at the same time, gold has come to this crisis at an exceptionally high level. And if the market is keen on taking profit, flight to safety towards some high-yielding assets that are highly rated, well, gold then sort of loses out. And that's what we have seen in the past week or so. So in a way, we could argue that if gold price was somewhat moderate, it probably would have spiked. It came into the crisis at a bad level, in my view. But in terms of the de-dollarization narrative, gold remains attractive in my view. Then there's a host of geopolitical questions. So let me take and see if I can handle these things. This is a fairly difficult question in my view to answer. About what sustained level of oil, I'm assuming, is a political cost outweigh the conflict objectives. First of all, I would like somebody to tell me what the conflict objectives are, because they seem to change on a day-to-day basis. Is it destruction of Iran's nuclear facilities? Is it nuclear and ballistic missile? Is it nuclear, ballistic, and drone? Is it regime change? Is it all of the above or none of the above? Not very clear. And therefore, what is the political cost? I think we just go for the very simple explanation, which is the taco doctrine. If the market sells off a lot, if oil is so high that the Republican senators and House members who are running for election in the midterms this year, they all come knocking on Trump's door and say, what are you doing? Trump will scale back some of his objectives or whatever he states as victory might be announced. But if the market feels that the US is capable of keeping the Straits of Hormuz open, if the market feels that there are enough alternative supplies and strategic reserves in the world to keep the quantity, I'm not talking about the price, quantity of energy flowing to wherever there is demand, then perhaps the taco moment doesn't arrive that easily. All we needed was a couple of words from Trump where he feels that his objectives are largely met for oil to go from a peak of close to 120 down to 90. So we're going to have some volatile days. And the reason I cannot give a very straightforward answer to this question is because the political calculus in terms of what are the objectives in Iran itself is shifting. And that's what makes it really, really hard to price this issue. Then a couple of India-related questions, so let's take that. First one is, when you say India is capable of managing the supply substitution from Russia, that would happen at market prices, correct? I don't know. Maybe it'll happen at a higher price, but why does it have to happen at a market price? Russia has been okay supplying India oil reportedly at a 40% discount. Even if they give it a 40% discount relative to 90, it is still a much higher price than what they were doing just a couple of months ago. So I think that India will still get some degree of concession, same with China, as far as Russia is concerned. But at the same time, the prices will be significantly higher than what they were before. So when we're talking about the impact on prices, impact on overall growth, I would urge you to read the note that just came out from us. Radhika Rao published an India report on the impact of oil, growth implication, inflation implication, everything goes way beyond the chart that I showed earlier. Do take a look at it, and we'll be happy to send you a copy if you reach out to us if you're not on our mailing list. Let me just take one more India question. I thought I had one. Okay, in case I can't find that, let me just talk about one on the equity market side. Is the equity market underpricing the tail risks of the Middle East situation, continues to strains on Strait of Hormuz from threat of strikes from Iran? Again, the equity market has a lot of stuff going on right now. AI-related rotation that was absolutely brutal that we have seen. If you look at, just go beyond the US, just look at Indian outsourcing company stocks. Each are down over 35, 40%. So that whole rotation has been absolutely brutal, and that will probably continue because the AI progress is not necessarily cognizant of what's happening in the Middle East. If we think about the issue related to the China-US sort of, the trade war, tech bifurcation, that's another issue related to the equity markets. And then there's the big story that I suppose has gotten buried, but it's a very much an alive story, is a private credit story, which is, in a way, actually having a negative impact on equity markets. Just look at the equity prices of large private equity companies. They're all down substantially in the last couple of months because the overlap between private equity and private debt and private credit's problem, or private equity's problem spilling over into the listed companies, all of that is taking place too. So as far as global equity markets, led by the US is concerned, AI disruption, China-US story, and private credit, already quite a few headwinds in place, giving investors excuse to sell. Add to that there might be even more excuse to sell. So yes, I do agree that the latest developments in the equity markets, turning around the moment Trump says a few words, might be a premature bounce. That bounce may well turn out to be a dead cat bounce. I would be very cautious and I would flight or take my portfolio toward a safer position if I were a typical investor. Well, we've run out of time. There were a few more questions, but we will save them for another day. Thank you to my participants. Thank you very much. Eugene, Philip, Wei Liang. Until next time, everybody, stay healthy, stay safe. We will come back to you next month. Bye-bye.